A bullish engulfing pattern is a reversal pattern in technical analysis and involves two candles. The first candle is negative and it is followed by a second positive candle which includes at least the full body of the previous negative candle. If the pattern occurs after a previous downtrend, it means that the downward momentum is losing strength and with it the negative sentiment. The pattern is a sign of upward price pressure and thus signals the possibility of a real trend reversal. We have also the bearish engulfing pattern, which is the opposite pattern and it occurs after a rising trend. In this case, the first candle is positive and its body is completely surrounded by the second negative candle, which is a sign of downward price pressure. As you may have noticed yourself, bullish engulfing patterns occur quite frequently on the chart, but opening positions solely on the basis of the pattern is a very bad idea. As a trader, it comes down to focusing only on the very best setups, and you can identify them on the chart by looking for other converging elements which confirm the bullish engulfing pattern. If you succeed in trading only the highest quality setups, this will undoubtedly have a very positive influence on your success ratio and thus also on your profitability. The first converging element is a minor price retracement. Since the engulfing pattern is a reversal pattern, it is important that the candles preceding the pattern decline, so that at least a small drop in price is observed. The pattern finalizes the price retracement. The second element has to do with the long-term trend. Reversal candlestick patterns in falling trends, whereby the long-term trend is still bullish, offer the best opportunities. After all, in this way, you are trading in the direction of the existing long-term trend. Rising volume at the time the second candle forms is a plus, especially if volume was noticeably lower at the time of the price decline. The greater the volume, the greater the interest from buyers at this specific price level and the greater the chance that it will become a valid reversal pattern. Support and resistance levels are basic concepts in technical analysis, and in this video I explain how to identify the most significant levels. A candlestick pattern that coincides with a previously significant support level is an additional confirmation of the pattern itself. Furthermore, in this example, we observe that the engulfing pattern occurs under strongly increased volume, and that is exactly what we mean by the concept of multiple converging elements. A final characteristic that supports the strength of the engulfing pattern is the closing price of the engulfing candle itself. That last candle should close at or near its highest price, which is a very strong signal of buying momentum. Long upper tails should be avoided, as this is a typical sign of selling pressure. Again, in this example, we are witnessing strong rising volume that goes along with the pattern. Recognizing a good setup is not enough. You also need to know how you are going to trade the pattern and what the next steps will be once a position is opened. In this example, a bullish engulfing pattern is visible on the date of July 14, where at the same time a double bottom was formed. The engulfing candle closes on the high of day with strongly increased volume. Thus the pattern meets several converging characteristics and is of sufficient quality. For the next trading day, a buy stop limit order is placed, a few cents above the high of the engulfing candle. The initial stop loss can be placed either just below the engulfing candle or below the most recent swing low. But in this case it doesn't matter, because in this example the low of the engulfing candle is at the same time the most recent swing low. The final step is to determine your break-even level and your price targets. The first resistance is visible at $72.5, so this represents the first price target. Make sure this first target has at least a risk-reward ratio of 1:1. If this is not the case, it is best to look for a setup with a better risk-reward ratio. When the price reaches this level, you may choose to bring your stop loss to break even and perhaps sell part of the position. The second logical price target was somewhere between 76 and 77 on this chart, and after a short period of consolidation, the second price target was also reached, where you could sell the remaining part or the entire position. So by just focusing only on the best patterns and making sure that your average winners are larger than your average losing positions, you will be able to trade this pattern consistently. Just remember that no signal is 100% perfect, so even if you only withhold the best setups, you will face lost positions. In the same chart earlier on, there was also a bullish engulfing pattern that failed. This pattern was of lower quality anyway, as there was still resistance slightly above the entry level. Initially, the price did go up, but eventually you would have been stopped out a few days later. However, that loss was more than compensated by the second trade that we've just discussed. One more example on this chart. The long-term trend is clearly bullish, while the current price action shows a slight pullback after an earlier price breakout. The engulfing candle occurs at the earlier breakout level, which now serves as support, while at the same time the rising SMA 20 also supports the price. The closing price is close to the daily high and the buying volume is clearly higher. A buy order for the next trading day is placed just above the high of the engulfing candle, with a stop loss just below it. First price target and also the break-even level is at the level of the red horizontal resistance line. Meanwhile, the price has reached $78 or a reward to risk ratio of more than 3-to-1. So finding tradable bullish engulfing candlestick patterns in ChartMill is pretty straightforward. We're on the homepage now. Just select the stock screener. And first I'm going to select some basic filters. So exchange US only, price above 5, and then the average volume. In this case, I'm going to select more than 300K. Now, to use the candlestick filter, the bearish engulfing filter, just select the indicator step and below candlestick open the drop down menu. Now ChartMill is capable of identifying bullish engulfing patterns on the daily chart and also on a weekly chart. Just keep in mind that it's not possible on an intraday chart. So in this case, I'm going to select the bullish engulfing pattern on the daily chart. And as you can see, we have 0 results. So yesterday, the last trading day, ChartMill didn't identify any bullish engulfing patterns on the daily chart for the US market. So I'm going to change to all. And now we have 2 results, Ericsson and Quilter. And I will slightly change the average volume to 200K. And then we have 3 possible setups. Also ON24 Incorporated gained yesterday 5%. Bullish engulfing pattern, slightly higher volume. That's also the case for Quilter. In fact, it's a double bullish engulfing pattern. And the second one is on higher volume. And then for Ericsson, there is also a bullish engulfing pattern. Now, maybe for Ericsson, I will draw the trend line. As you can see, there is an ascending trend line. And the first real resistance could be over here. So even if you go long here, a buy stop limit just above the high of this last engulfing candle with a stop loss below the last swing low, it's kind of a 1-to-1 risk reward ratio. Now for Quilter, next support level, the most important support level, is just a bit lower. So it's definitely possible to open a position once this high is broken, and then the first target would be the descending SMA 20. But just keep in mind that there is still some support lower than this price level. And then for ON24, as already said, this is a difficult one because, as you can see, some days ago price did break a support level. So now it's kind of retesting that support, which is now resistance. These are daily charts, but what I like to do is change the view. So in the blue horizontal bar, open the drop down menu next to view and select 2 charts. In this way, I have a weekly chart and a daily chart next to each other for the same stock. And then you have a glimpse of the long-term trend on the weekly chart, which is for all these stocks, the long-term downward trend is bearish, as you can see on this weekly chart. Considering the long-term downtrend, I myself am rather reluctant to go long in that case. But these setups can sometimes be very interesting for day traders on the intraday time frame. First, I'm going to change the main chart to 15 minutes. and periods best fit 2, and the secondary chart, change it to the daily time frame, and the period can stay the same. Now take a look at Kilter. We've had already defined the first possible resistance level after these 2 consecutive bullish engulfing patterns. That would be approximately around $108. So now I'm going to draw that level on the 50-minute time frame, so approximately 108. And if you consider the swing high, it would be rather 109 or 109.5, but let's keep it at 108. And now take a look at the intraday 50-minute chart. This is resistance, and this is definitely an ascending trend line. So a possible setup would be to go long if a candle closes above this horizontal resistance line with a stop loss below the ascending trend line, and then the first target at 108. That's definitely a 2-to-1, and if you consider 109 the first target, it will be a 3-to-1 reward to risk ratio. So that's a very good and very decent setup to consider if you are an intraday trader. This is a great example of how specific setups on the daily chart can be used to define very good intraday setups. The screening is done after the markets are closed, and the stocks for which you have defined a swing or day trading strategy are then transferred to your trading platform, ready for the next trading day. So if you don't have a ChartMill account yet, be sure to create one using the link below in the description. Account registration and basic use of ChartMill is completely free. You just need a valid email address. We do not ask for any payment information, and rest assured, a free account will never automatically convert to a paying subscription. The only thing we would appreciate is a like for this video. Thanks for watching, and I'll see you next time.